Hello everyone, welcome back to All Financial Discussion channel. For this video, I'm going to do a deep dive on Singapore Bank. Okay, so normally when we actually invest into banks, for example in Singapore, we actually look for the dividend. So this video, okay, so we know that Fed probably will cut the rate soon. So therefore this video, I'm going to analyze whether it is still so-called attractive to buy Singapore Bank for the dividend. So this video, I will consider both scenario, both the bull and the bear scenario with potential interest rate cut. So this will be the objective of this video. Before I continue, guys, I'd like to urge you guys to help me by like this video. Just give me a few seconds. Press the like button now. For those who are new to this channel, and if you want to encourage me, please consider to subscribe to this channel and turn on your notification bell. Once again, thank you so much for strong support. A quick disclaimer. Okay, so I am not a licensed financial advisor. The content in this video is for entertainment and education purpose only and should not be considered financial advice. In this video, I'm simply showing you what I may be doing. Please conduct your own independent research and consult a professional if needed before you commit to an investment. Never invest more than you are willing to lose, and always be sure to read the fine print and the terms and conditions before you commit to an investment. With this, we are ready to kickstart today's discussion. Okay, so firstly, okay, like I mentioned earlier on, to invest in Singapore Bank mainly for dividend during a Fed rate cut cycle. Okay, so this can be a very complex decision. So therefore, this video, I'm going to present both the risk and also the potential, okay, that you have when you actually invest into Singapore Bank when Fed actually cut the interest rate. Although I understand that most of the investor will actually shift their investment into REITs when rate actually cut. However, I always emphasize the importance of diversify your risk. So over here, you can see that there is actually a list of blue chip in Singapore, okay, for dividend, not only under the banks and REITs. We also have the industry, utilities and infrastructure, telecommunication, and also others. Okay, but this video, okay, so I'm not going to discuss which dividend to invest. Rather than that, I'm going to focus on the bank for this video. Okay, so what will happen to the bank share when Fed actually cut the interest rate? Maybe my next video, I will discuss which dividend to buy in order to have the best possible yield. When rate actually cut their interest rate, okay, so we need to understand the bear situation so that we can anticipate the move correctly. Okay, so let's come to the direct impact on banks regards on their profitability. Okay, so the core banking practice, okay, of borrowing short and lending long. Okay, so what is this? Okay, so when we actually deposit our money into a saving account, bank actually borrow short, okay, because the duration is short. When we actually put the money into our saving account, typically it will be maybe 1 month or 2 months. So the bank actually borrow, okay, in a short term, and they actually lend in the long. What does lending in the long means? Okay, for example, we take out a property loan, for example, 30 years. So therefore, this is what it means by lending long. And because of this situation, okay, borrowing short and lending long, okay, so this make bank actually very sensitive to interest rate change. The record profits of DBS, OCBC, and UOB, they are actually directly by the rising US and also Singapore interest rate. Okay, so Singapore interest rate does not easily, so-called, does not follow the US. Okay, but later on, maybe I will explain. They just take a reference to a pool of currency. But technically, when US so-called rise or drop their interest rate, most likely Singapore will follow. Okay, so basically, okay, the profit of the bank, they actually depend on this, what we call the net interest margin. Okay, so what is this net interest margin? It's over here. Okay, so this net interest margin actually represents the difference between the interest a bank earn on loan and the interest it pay on deposit. Like I mentioned earlier on, okay, when we actually take a property loan, okay, so basically this is what it means. The bank actually earn an interest based on a loan. And what is this interest it pay on deposit? When we actually deposit a money into our saving or into our fixed D, okay, they actually pay us an interest. The difference between these two interests, this is what we know as NIM, net interest rate. Okay, so a reversal of this trend. Okay, so when the interest rate actually drop, okay, and everything still the same, this actually put the downward pressure on this NIM, net interest margin. As a falling interest rate environment is well understood, okay, so this will be a headwind for bank profitability. Okay, so when central bank, okay, so for example, like Fed cut the interest rate, like I mentioned earlier on, MAS most likely will also cut the interest rate. Banks are often forced to lower their lending rate. Okay, for example, the mortgage, for example, the business loan faster, okay, then they can actually reduce the rate pay on deposit. Okay, so this is especially true for saving and current account. Okay, so what happened here is basically when Fed or MAS actually cut the interest rate. Okay, so the bank need to take a quick response. Okay, if not, no one will take a loan for them. So therefore, bank actually will do a drastic change in terms of their lending rate so as to have a better so-called attract more mortgage and more business loan. So therefore, because of this, most of the time they will not be able to reduce, okay, the interest rate, for example, for the deposit or the fixed D. So therefore, okay, the margin of this NIM become narrow. And when they actually become narrow, this means that the bank actually has much more lesser profit. Okay, so this is actually the key issue. So therefore, the direct impact on the property actually depend on this NIM. And when Fed and MAS actually cut the rate, and because of this reason, they actually reduce the so-called the difference between the net interest margin. So therefore, overall, the profit for the bank actually drop. Second, get the lower income from the wealth management. Okay, so Singaporean banks actually possess significant wealth management and also the treasury operation. Okay, so in a high interest rate environment, okay, the bank actually generates substantial fee from the sales of product. For example, they actually so-called has this fixed deposit, bond, and structured notes, which have a very nice so-called business, and therefore they actually earn some form of fees. So therefore, a shift, okay, when the interest rate actually drop, okay, so this could damn the demand for this product. So therefore, the potentially reduce this stream of fee-based income become an issue for bank also. So therefore, from here you can see that the second consequence for bank is when Fed and MAS actually reduce the interest rate. Okay, a lot of us, for example, okay, we will do lesser fixed D, we will do lesser bond, and also the structured notes. So therefore, with this, okay, the bank actually reduce their income, okay, because they can collect lesser fee from this kind of service. Next, the third one will be potential for economic weakness. Okay, so the Fed cut the interest rate definitely for a reason. Okay, so usually, okay, it is used to simulate a slowing economics. Okay, so therefore, if the US and also the global economies actually go into recession, okay, so this can lead to lower loan demand. Okay, so if it's not rosy, definitely not many people want to take up a loan. Okay, so many people will take out a loan when the demand is high, but when potential recession, very little people want to take up a loan. So therefore, the business and individual will borrow less, and when they actually borrow less, the bank actually has lesser business. So therefore, the term of profitability also reduce. Next, also on the higher non-performing notes. Okay, so basically what is this? Okay, so you know that when economics is weakening, okay, a lot of borrower, they may default their loan. So this become a big issue. This actually need to force the bank to set aside more provision, okay, which directly hurt their bottom line. Okay, because they set more regulation, okay, in order to prevent people from default, and therefore lesser amount of people can actually loan. So this become another issue. So over here you can see that three drastic so-called curb for bank to make a profit when Fed actually cut the interest rate. Before I continue, guys, okay, if you have learned something from this video, urge you to help me by like this video. Guys, help me press the like button so that this video can reach out to a larger audience. Thank you so much. Again, appreciate if you have learned something, appreciate that you can subscribe to this channel and turn on your notification bell. Once again, thank you so much. Earlier on, I go into the bear situation. So now this video, I'm going to discuss on the bull situation. So not everything is so-called damping when actually Fed cut the interest rate. So let's quickly understand the bull case. Okay, so this might be still a good idea. Okay, so despite the headwinds, okay, it's not all doom and glory. Okay, so basically there will be reason why investors still see some value to invest into bank. Okay, so the first one is dividend yield become more attractive. Okay, why this become more attractive? So when interest rate fall, the return from safe asset, for example, in Singapore, we have this Singapore government bonds, and fixedly they will also drop. So when all these things drop, therefore, investor will look for a new market to invest. So therefore, Singapore bank may be attractive now. Okay, so as you mentioned over here, a stable, well-capitalized bank like DBS actually offer a 5 to 7 dividend yield. Okay, suddenly look much more attractive as compared to a 2.5% fixed D or a 3% government bond. Okay, so this can drive investor to seek income towards bank stock, supporting their share price. Okay, so this is the first reason. Okay, so not everything become doom. Okay, so therefore, because of the drop of the interest rate, and therefore Singapore bond actually drop, fixed D also drop. So investor look for another better yield. So Singapore stock definitely can be very attractive also. Okay, when the investor actually go into the bank, therefore their share price will increase. Next, strong capital buffer and prudent management. Singapore's banks are globally recognized for their strong capital adequate ratio and prudent risk management, having built out significant capital reserve during prosperous year. Okay, which means that bank, when at their good year, they actually save enough capital to so-called to outlast the doom type. So therefore, as a result, their dividends are generally considered sustainable. They are unlikely to make drastic cuts to their payout unless the economic situation becomes severe. The focus is on the sustainability of the dividend rather than just the current high yield. Okay, so therefore, okay, as he mentioned over here, okay, even though Fed cut the interest rate, but the bank still want to attract people to invest into their share. So therefore, most likely they will remain the dividend, okay, around 5%. So therefore, because of this, okay, this may be a potential upside. Even though when Fed cut the interest rate, this can be still a bull case. Next will be the potential for capital growth from a soft landing. Okay, so the potential for capital growth remain even, okay, for a soft landing scenario. For example, if the Fed actually curb the inflation, okay, without causing a severe recession, okay, bank actually benefit from the steady loan growth and manageable credit loss, enable them to post strong, if not profit. Okay, so basically this is another potential. Okay, so basically if Fed can potentially so-called have a soft landing, okay, but the market still have a lot of potential. So therefore, with this, okay, we actually can consider bank still at the bull case. Next, okay, on the Singapore unique monetary policy. Okay, remember that Singapore does not set a domestic interest rate. Okay, so instead, the MAS actually manage the Singapore dollar exchange against a basket of currency. However, okay, most of the time, the Singapore interest rate actually follow very closely to the US. Okay, so a Fed rate cut will almost certain lead to lower SORA and SIBOR and SOR rates, which directly impact the net interest margin of our bank. So therefore, the transmission mechanism is actually very direct. Next, okay, let me explain, okay, when you actually work as an investor, okay, so instead of a simple yes or no, I have actually this framework for you to make a decision. First, check the dividend sustainability. Okay, so look at the bank dividend payout ratio. It is comfortable. Okay, so let's say 50% of the earning, or it is actually stretching higher. Okay, so a lower ratio means more safety. Okay, so basically from here you can see that if it is a very safe and very comfortable 50% of the earning, okay, so therefore, okay, this potentially can mean that the bank is actually still very safe. Okay, so next you can actually listen to the CEO and CFO comment. Are they confident about maintaining the dividend? Okay, so usually they are actually very confident unless there's a crisis. Next, analyze the why behind the rate cut. Okay, so why the bank still consider bullish and why the bank still consider bearish. Okay, so basically it's the Fed cut, okay, because inflation is still under control and they are just normalize the policy. When this actually happen, this is actually very positive for bank. Okay, so basically if Fed cut the rate, okay, because of inflation is already under the control, so this is actually to normalize the policy, and this is actually very ideal for bank. Okay, so next will be on the recession cut. Okay, so if Fed cut the interest rate aggressively, okay, because the economics is collapsed, okay, so this is actually very negative for bank. So therefore, over here you can see that you need to understand the situation. When Fed cut the interest rate, is it because inflation is already under the control, so therefore they cut the interest rate, or they potentially see a recession happening? So this is actually very bearish for the bank. While for this case here, okay, when actually they cut the interest rate because inflation is under control, this is actually considered as a bullish for the bank. Next, consider a long-term perspective. Okay, so for example, if you are investing for a very long term, more than 5 years, okay, the short term, okay, so this NIM compression is just one part of the cycle. Singapore banks have proven their ability to grow through cycle via region expansion, digitalization, and growing their fees income. Okay, so basically, if you go for long term, okay, you don't worry about whether Fed cut the interest rate or not. Basically, the banks has many different possible revenue. Okay, so therefore, okay, don't look at the short term. So if you plan to go for long term, this can be good for you. Buying during a period of pessimistic, okay, when the share price has dipped, okay, due to rate cut, this can be a good long-term strategize if you believe in the bank's fundamental. Next, diversify your dividend portfolio. Okay, so as I mentioned, don't put all your eggs into the bank dividends basket. Okay, so consider other Singapore listed high dividend stock that might perform differently in a rate cut environment. Okay, for example, as I mentioned, most of the investor actually will move into Singapore REITs. Okay, so basically when they actually cut the interest rate, a lot of them actually will move into REITs. Okay, we also have the utilities and defensive stock. Okay, for example, Singtel, Singpost, maybe not so ideal nowadays, maybe Singapore Technology, or this. Okay, so basically these dividends are less tied to interest rate. Next, come to the conclusion. Should you invest in Singapore bank dividend when Fed actually cut the rate? Okay, so basically, let me do a quick conclusion. If you are chasing the highest possible dividend yields and expect no impact on share price, then you need to be very, very careful. When Fed actually cut the so-called the interest rate, there will be definitely impact. Okay, because their earning and potentially their share price, they are likely to face headwind. Okay, so therefore, for this case here, then you probably won't want to invest into Singapore Bank. So if you are a long-term investor who believe in the fundamental strength of DBS, OCBC, and UOB, then you are looking for a sustainable source of income, then this is likely to remain higher than what fixed deposit actually offer, then it can still be a valid part of your portfolio. A potential strategize could be dollar cost average into the banks rather than invest a lump sum, as their share price can be very volatile, especially for a rate cut environment. In short, the end of the rate hike cycle changed the story for Singapore Bank from a screaming buy to a watchful hold or strategic accumulation. The key is to manage your expectations and understand the new drivers at play. With this, okay, I'd like to end my discussion. Please help to like this video and subscribe to this channel. Once again, thank you so much for strong support. I hope to see you guys soon. Bye for now. Thank you so much.